Foreign direct investments, or FDIs, are important contributors to the economic development of emerging economies like India. To attract FDI inflows, India has been improving ease of doing business along with the introduction of production-linked incentive schemes under several ministries. Until last year, these initiatives were successful in increasing the FDI inflow to the country. But for the first time in a decade, the past year witnessed a 16% contraction in FDI inflow. Prior to that, FDI inflow to India went up by 20-fold from FY 2004 to FY 22, reaching an impressive $83.57 billion from $4.3 billion. But in FY 23, the FDI inflow plummeted to $71 billion. The first quarter of FY 24 also followed the trend of falling FDI inflows. In the June quarter of the current financial year, FDI inflow to the country was $10.94 billion. Compared to the same time last year, this is a 34% decline. Key sectors like computer hardware and software, telecom, automotive, and pharmaceuticals observed reduced foreign direct investment during the preceding quarter. The FDI inflows to India from countries like Singapore, Mauritius, the US, UK, and UAE also declined in Q1 FY24. However, there was an upswing in inflows from countries like Japan, Netherlands, and Germany. This prompts the question, what factors contributed to the decline in FDI inflows to India?
There are uncertainties, post-pandemic, there are uncertainties. The recovery, as the investors see it, has not been up to the mark, and this year 23 could actually be worse. So if you look at the overall situation of the global economy and the headwinds which is being faced, especially because of the deflation in China, and that is going to have an impact on the rest of the world. This, of course, doesn't augur well at all. So this year too, one should expect similar tendencies to take place.
The shrinking of FDI inflows to India is attributed to several factors, like the global economic slowdown triggered by the pandemic, the Ukraine-Russia conflict, and deflationary pressures in China. Additionally, rising interest rates in the US and EU had a direct impact on India's FDI inflow, given their prominence as major investors. The global growth pessimism is reflected in the decline of merger and acquisition deals in the first half of 2023. According to a Grant Thornton analysis, compared to the first half of the last year, there was a 92% decline in the value of mergers and acquisition deals in India. Hopes were pinned on substantial FDIs in semiconductor manufacturing, buoyed by the 76,000 crore rupees PLI scheme. But foreign investments have been less forthcoming so far. Despite the $10 billion subsidy earmarked for the Vedanta Foxconn project, the venture fell apart. Also, data from May 2023 shows a 72% decline in foreign investments in Indian startups compared to the same period last year. So, what are the major challenges and immediate remedies for arresting the decline in FDI?
The government should streamline the process. We have to learn from countries like UAE, etc., which have made opening up foreign companies, local subs, and bringing in the money and taking it back very easy. The other biggest challenge in India is that bringing in money is easy, taking money out from India is very, very tough. So till that reform doesn't happen, people will be very hesitant to bring large pools of money into India. The third thing is that, overall Indian economy needs to allow, more and encourage more FDI into critical sectors like financial services, insurance, and even opening up of the Indian capital markets, because that is something that will attract a lot more foreign capital into the country.
JNU's Dhar points that FDI inflow to India has not been significant when compared with India's GDP. So there is a need to scale up the foreign investments in India for the macroeconomic balance.
This isn't good news for the longer term, development prospects for the country. So if there was larger investment coming into the manufacturing sector, for instance, there would have been a greater opportunity for us to increase our presence in the global market, because manufacturing is the real bottleneck that we are facing today. And then many other things, for instance, a large trade deficit that we face, especially vis-a-vis China, that could have been taken care of. So again, I would say that this doesn't augur well for our macroeconomic balance.
According to economists, upskilling the workforce and simplifying regulations are the most effective strategies to entice foreign investments to the country. For now, the current uncertainties can be attributed to global developments that are hindering the smooth inflow of FDI.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
She has ambitions of becoming a brand. Business Standard.